Hey guys, how are you? Looking at interest rates, and this is your 10-year US government bonds. This is a long period of history. This is a monthly chart. So every single candle represents an entire month. Further to which, this has got a history that brings you from my entire investing career, which commenced in just a month before the 87 crash, when I put my entire net worth into the market before disappearing into the army for 2 years. So that is it over there. Now, the key element I want you to recognize amongst this, with this being a log scale chart, is that in actual fact, the movements in interest rates in percentage terms have grown ever more volatile and extreme. This is the gift of your central banking cartel, particularly the Greenspan no-pain economy, who took over and came in as Fed Chief Satan roughly around this period in 1987, and just in time to capture the crash. So if I draw over here, he was over here. And yes, indeed, he was responsible for a large amount of subsequent bubbles being built in his very accommodative approach to interest rate policies. So let's just go through some of that history. So that was the biggest single percentage crash that the Dow and the S&Ps encountered in 1987. And as you can see, interest rates as a result of that crash all the way through into 94 actually were in a downward trajectory. There you go, you can see them. They then firmed up a little bit, and then we had the first of an emerging markets crisis. It was the tequila crisis because it particularly involved Mexico. They were being maneuvered into the North American trade agreement. That's NAFTA, I think it is. And they also had a prominent person in their parliament be assassinated during that time, and they did a default on their currency. I will point out that it was also the beginning of the Turkish lira's many sell-offs, so there were other emerging nations involved, but the actual default was a Mexican one, hence giving it its name, the tequila crisis. Then we had a slight rebound, and we had 1 point over here. We softened, and then we came back and picked up the 97 Asian crisis, which were the other emerging nations, very much of the Eastern variety, that caught up with the likes of Mexico and the Turkish lira and had defaults and various aspects that went involved with it. Further to this, you can see another softening of interest rates. What should be obvious is that these red circles broadly have been heading lower, and the lows have also been heading lower. In other words, more and more the medicine of monetary policy was being applied and was running out of runway in terms of how much effective use it could have. And further to which, as I've already indicated, in percentage terms, the volatility of this curve has actually increased. We had a degree of firming. Greenspan's famous in 96, he spoke of irrational exuberance over here, but the interest rates only really properly started going up. In fact, they continued in a downward trajectory because of the Asian crisis, further goosing the stock market and the tech boom of the era. And only roundabout in the late 98 period did he start raising some rates, or did the bond yield illustrate that. Eventually topping out over here at the dot-com crash, which was just post the 99 period. And then you can see how interest rates then responded as far as the 10-year T-bill was concerned. And once again, you'll notice the moves are becoming ever more extreme in percentage terms. So that was a big period of reduction in rates. Then broadly it moved up, but in a grinding fashion, kind of like a rising wedge there, a little bit of a squeeze. We got 2 tap outs at this level, and the second one was our 07 subprime crisis. Now this was huge, as you're well aware, and you can see the percentage effect on interest rates brought about by that. And that was the move that resulted, bringing us into the market lows. That's the equity market lows of 09, where everyone was exceedingly more. But of course, QE came in, and that led to a snap up, which tapped out once and then tapped out a second time as QE1 ended over there. the fear came straight back because the heroin was being taken away and started to fall. And of course, QE2 emerged. With not quite the same effect of feel-good factor, and then of course it ended too, leading to further softening in during this period. Now, from the 09 lows, China was the new buyer of last resort. That was the narrative through to 2014, where it really started to feel exceedingly soft. Many of the commodities started to turn down in 14, with oil being one of the last in July, turning down. Now, gold and silver had hit their highs in 11 over here around about this period, and then it subsequently pulled back. But the other industrial commodities held and grind and held, also hitting highs in 11, but had held their levels, a little bit softened, and then they started spilling 13 and 14, and with oil being the last shoe to drop. That is your great Rockefeller tax. They realized there was no power left in the economy. There also wasn't much room to move on interest rates. So your tax on your energy got reduced to try to stimulate some heat back in the economy, and oil broke in July of 14, the $100 mark, and actually ended not much above the $25 mark at its lows in and around 15 and 16. Now, I'd appeared on WorldCom News, and I'd suggested that in October 15 that we'd have a very weak start to 16. This was part of the debt narrative of China that had now gone from fairly low debt to being super indebted, future-proof, built villages into the future, no longer buying the commodities of the world as all these prices started to slump. And this, of course, would have had an effect on Australia and many of the Canadian commodity environment as well. And we had the G20 meeting in and around the beginning of 2016, when we went in sheer pain in the 2016 meeting. Everyone was deeply concerned. There were some pulling together of heads, and unofficially known as the Shanghai Accord, the key nations of Europe, US, Japan, decided to take China out of the news and to be supportive and allow its peg and the dollar both to ease, giving a stimulus both to America and particularly to the Chinese, where they also slipped a little bit on their peg to allow them to devalue without taking too big a hit in their output. They've done their bit, getting the leprosy disease of debt and trying to keep some heat into the global economy. By the way, just before that, the December 15, the first rate hike of the Fed was actually done. So this was in and around this period here. QE3 ended here. And then that first Fed hike occurred here. Now, it had been so well signaled. This is this orange area, and it was so gently brought in, and it was so late in coming. And the suggestion was it would be ages before the next week. That's that the hype that brought it in and the subsequent tone that was brought in still saw bonds easing and gaining in value despite that increase. Till that point of the Shanghai Accord. Then the T-bills, 10-year T-bills started to gain. Now, we pointed out around about July, that's over here, that 34 months, the typical average from the first rate increase, would bring you to October. And we felt that our first recession within this depression that we are in, that you can see in this entire interest rate cycle of all the fraud and fakery that has been brought to us by our central banking cartel that needs clearing out on a macro cyclical level because monetary policy has been brought so low. We felt that a cyclical recession within this entire environment of failure would come in and around the October 18 period. That did indeed occur. But the Fed didn't realize it at that point, with the Fed chair, Powell, saying in October we're a long way from rates being neutral, to November saying, we're not so far after a single increase, to earlier this year actually saying we're as good as there and doing a U-turn on rate policy, till recently, not more than a few days, committing that for the rest of 19 no further rate hikes would be on the card on balance of probabilities, and of course the existence or the scope for cuts may indeed be in need. So what is this telling us? We're in a downturn of interest rates on the US T-bill. That means they're going to yield less, more money will be going into them. The strength will be with the debt. Yes, before all of this collapses, first the fear mechanism drives people into the great debt instruments, despite the fact that in real terms versus inflation, they are probably losing value for you, almost certainly. And in fact, in other parts of the world, without taking inflation into account, they're in negative real environment. Expect that negative concept to reappear, which makes cash a problem, hence the war on cash, etc., because at least in cash, you don't get money taken out of your account in a negative interest rate environment. Expect this to continue. I would see further downside, and it'll be driven by fundamentals. We note that for the large degree, the banking crisis in the Eurozone has been kept out of the front pages. None of that has ever been solved. It's all been the focus on Brexit. Expect those things to rear their heads very, very urgently once Brexit's headlines start to dim and other of the global malfeasance to all start popping up like weasels. Okay, so with that heading down, it's going to be a fear environment. Draghi said himself, all the risks to the downside. So prediction is bonds will actually go up on rate rises, prospects expected to decrease, not increase. And in actual fact, my suspicion is the next move the Fed may make could even be a cut, not another hike in 2020, even if they take no action during 2019. Okay, I hope that helps. By the way, the best way to understand this when many things are only due to go down is to learn and have a method for trading to the short side. You can attend our free webinar by registering on themarketsniper.com or grab our mini series, which will tell you a little bit about our trading focus and some of the principles around which we operate. That's all driven through themarketsniper.com. Please follow and share. And also, a final point, hit the bell so that you get notifications for these videos in future releases. Okay, thanks for your support, and I look forward to updating you on what I suspect is a downturning interest rate environment where the only things that are probably going up are bonds. Think about this when you view equities and other asset classes. Okay, bye for now.